Mutual fund Sahi hai. You would have seen this ad in your mobile or TV, but do you know what mutual funds are? Are mutual funds a good investment option? How risky can mutual funds be, and which mutual fund you can start with? I will provide answer to all of these questions in this video. So hi guys, welcome to my channel. This is Sarthak and today's video is about, are mutual funds a good investment option? A bonus point about this video is I'll also tell you one mutual fund from which I started my investment journey, and actually I still invest in that mutual fund. So without any further delay, let's get started. Let's understand the concept of mutual funds by a simple example. Say you want to go on a trip from Delhi to Jaipur. One way of doing it is doing all the research by yourself, booking your hotels, renting a car, hiring a driver, creating the itinerary to all the places you want to visit. The other way is buying a package from a travel agency which handles all the bookings, provides you a driver, and also has an itinerary of places to visit already. In turn, you will be paying them a reasonable fee. Mutual funds is somewhat like that. Instead of individuals selecting stocks or bonds and then investing themselves, what they do is put some money into a mutual fund, and then somebody who is a professional investing manages the pool of money from all the people to invest in stocks or bonds for them. For example, for an equity or stock market based mutual funds, people will put their money into a mutual fund, and then a fund manager will create a portfolio of shares for them to generate a good return, and in turn the asset management company will take some fee for managing the portfolio. Now, talking about categories of mutual funds, there are three main categories. Number one is equity based mutual funds. These mutual funds mostly invest in shares from the stock market. Number two is debt based mutual funds. These mutual funds mainly invest in debt based assets like government bonds or corporate bonds. Number three is hybrid mutual funds. These invest in a mix of equity and debt-based assets. I will mostly talk about equity-based mutual funds in this video. Equity-based mutual funds are further categorized into these categories. Number one, large cap mutual funds. So large cap mutual funds invest mostly in the large cap companies, which are the top 100 companies based on market capitalization. Number two, mid cap mutual funds. These mutual funds mainly invest in mid-cap companies which are from 101 to 250 based on market capitalization. Number three, small cap mutual funds. These mutual funds mostly invest in small cap companies which are the remaining companies starting from 251. The fourth category is multi-cap mutual funds. These mutual funds invest in a mix of large cap, mid cap and small cap companies. Number 5, ELSS mutual funds. These mutual funds are tax exempted under Section 80C, but they also have a lock-in period of 3 years. There are other categories as well, like sector-based mutual funds, but you can explore them yourselves. Let's pick up a mutual fund from Grow and go over some terminologies. So I'll select the category first. Let's select equity and then large cap, and then select the first mutual fund that we can see. So the mutual fund is Axis Blue Chip Fund, and you can see it's a large cap fund with a 5-star rating. And a few details that you can see on this page are the NAV. The NAV is the market value of this mutual fund, which is similar to the share price of a share. Then you can see the fund start date, the fund size, the amount of money that people are putting into this fund, the expense ratio, which is the fee that the AMC will charge for managing the portfolio. Then you can see the historical returns of this fund. When you go down, you can check the holdings of this fund, the amount of holdings which are in equity and debt, then sector-wise allocation, top holdings of this fund, and then at the bottom you will find a very important thing, which is exit load. This is the penalty that is charged to you if you sell before a specified time period. So now let's go over how you can invest in a mutual fund. So there are two ways mainly. Number one is the monthly SIP, in which a fixed amount is deducted from your bank account and invested in this mutual fund, which is a very easy way. And the other way is investing one time, where you choose the amount and invest at that particular time. Things to look out for before investing in a mutual fund. Number 1, fund size or asset under management. So asset under management is the amount of fund the mutual fund is managing. Usually the bigger the fund size, the better. Number 2, expense ratio. So expense ratio is the annual fee the mutual fund charges for managing the portfolio. The lower the expense ratio, the better. Number 3, history of the mutual fund and its historical returns. So if the mutual fund is a bit old and gives good returns over the years, you know that you can trust that mutual fund. Number 4, exit load. So exit load is a penalty which is charged if you sell before a specified period. Usually some mutual funds have exit load and some don't, so do look out for the exit load. Number 5, the ratings of the mutual fund. There are different agencies which rate mutual fund like CRISIL, Value Research and all. So you can check out the rating of the mutual funds, then compare between mutual funds based on their ratings. What are the benefits that mutual funds offer? Number 1, a person with less knowledge or less time to research can invest in mutual funds with lesser risk than stock market. Number 2, mutual funds usually give a good returns, usually over 10 to 15% annually over a long term. Number 3, mutual funds are diversified. Every equity-based mutual fund has multiple stocks in its holdings. Number 4, you can invest in mutual funds with zero fee on investing. Number 5, it's very easy to invest in mutual funds. You can start with as low as rupees 500 per month using the SIP. It's time to reveal my first mutual fund. So the name of the mutual fund is UTI Nifty Index Fund. Index funds are passive mutual funds. They just track a market index, which is Nifty 50 in this case. The good thing about them is the expense ratio is very low, the returns are good, and the risk is also lesser. I still have an SIP in this mutual fund because I think index funds are a good option to invest some of your money. A person who does not know how to choose a mutual fund can start with an index fund. A small disclaimer, I'm not asking you to put your money anywhere. It is good to understand what is right for you and then taking the decision yourselves. Let's now talk about a few risks associated with the equity-based mutual funds. Number 1, high volatility of returns. So equity-based mutual funds invest in stock market, and by the nature of stock market, they have high volatility of returns. So you need to be very patient when you invest in equity-based mutual funds. Number 2, equity-based mutual funds are not good for short-term investing. You should keep that in mind that you should invest for long-term when you are investing in equity-based mutual funds. And by long-term, I mean 2 to 5 years. Number 3, liquidity risk in ELSs. So if you are investing in ELSs mutual funds, you should know that they have a lock-in period of 3 years and there is a liquidity risk in case you need that money early. So you should only invest that money into mutual funds that you can keep aside for a few years. I've covered a lot in this video, but there is still a lot uncovered. Do you have any doubts or questions? Do mention them in the comment section. Also, if you think I'm creating useful content, do leave a like and hit that subscribe button so that it reaches to more people. With that said, thanks for watching and good luck for your investment journey.